obviously we're looking at the geopolitical situation, and that's always kind of like the black swan sitting in the market. But the two things that I think we still need to go back and focus on, especially as it pertains to the United States, that's what we need to ask is what impact, economic impact outside of energy prices would a Russia or a Ukraine have on the United States corporate profits? And the answer is pretty close to zero, whether people want to hear that or not. I was researching it last night, and I found that Russia, their income, or what they would call GDP, is 1.4 trillion. Ukraine is 155 billion. And kind of put that in context, United States is 24 trillion, and China is 17 trillion. So the only reason I list that is kind of gives you like a scope of economics. Again, I know how we're feeling about this, and I don't want to take away from human life or the qualitative features, but our job for you specifically is to kind of interpret this and understand how it's going to impact things economically, and how does that affect your financial goals. So
certainly it causes any surprise like this. It's not really a new surprise. It's something that's been going on for quite a while, and the market really has the worst periods when there's major surprises. Like in 2008, we had the financial crisis. Hardly anybody saw that coming. So it really caught us by surprise, and then things really unwound from there. This is not a surprise, right? We know Russia's been threatening. They've been already in these countries.
Yeah, they've been in conflict since 2014.
Exactly. So we know this is coming. We know inflation's coming. We know the conflict is here and will continue until it's resolved. We don't know what it's going to resolve to, but we're pretty, I would say, confident that it's not going to be a global conflict.
Actually, yes, some of the positives, find some of the positives that are happening, especially economically. When you look at corporate profits, does this impact the United States corporate profits? And the answer is no. And maybe it does, because it slows the Fed down from wanting to raise interest rates, which was kind of built into the markets and planned. But what we know is that uncertainty in the markets is what always causes this type of volatility. I mean, this morning futures were starting off 3% negative on the NASDAQ and just closed 3% positive. I mean, that's almost an 800 point swing in a day on the NASDAQ, one way or the other. But you think about the things that have been out there, whether we're going to reopen. We have an midterm election coming up. People are wondering what's going to happen with that. You have whether we're going to raise interest rates or not. You have the geopolitical. But at base, you have inflation. At base, what is happening in this country in corporate profits and in the consumer is still very strong. In fact, they're still planning on I don't know if anybody's seen some of these earning reports that are coming out, but it's not even close. Like, these companies are coming out and reporting earnings way above analyst estimates. Like Airbnb, as an example, came out 74% higher revenue than what analysts were forecasting.
We just listened to one commentary, and he said two things about Putin. He said, one, he's very cruel. He's a cruel, mean dictator. Secondly, he's not very strategically smart. And what he was saying by that is that this is really a bad move for Putin, whether he wants to admit it or not. The world, except for China, is now against Russia, and all the sanctions will come from not only us, but NATO. And so he's going to have a very difficult time making any economic progress in Russia when the rest of the world, again, excluding China, is going to be coming against him and not doing business with him. So they're talking about some pretty significant, again, penalties, if you will, or policies to really hurt him and what he's trying to do.
And our goal is always kind of bring things back to perspective. And really, that's what we need. We need, especially in times like this, we need perspective. So if you kind of think about it, the NASDAQ is down right now, is down 24 to 23% from November highs. It's down 20% from January. The S&P is sitting down 11%. But I was thinking about it today, and I've had some conversations with clients. And when you go back to planning, which is where we start, the planning really sets us up for times like this. Because what we do is we stress test your portfolio against anomalies like 2008. And then we say, if that were to happen, based on your cash flow need, do we have 5 years worth of your difference or your deficit compared to income streams you have coming in? And we make sure that's not associated with the market. And so by doing that, we might not like it when we see the declines, but we already know that you're going to be okay. And it presents opportunities for us to take advantage of markets like this if that's what we choose to do. Or it at least, at minimum, gives us peace to know, hey, I'm not pulling from my equities that are down to get income that I need today. And that's what destroys people's retirements. If you're a forced seller on your securities and you're having to sell out at 20% discounts to get your income, you will cut years off of your retirement and the sustainability of it. So prospectively, I've done planning, and Paul's done planning. We've all done planning with our clients for many years. That's been the base of what we do. And I could go back to 2019 and 2018. Prospectively, what has happened for people right now, and yeah, it feels bad, is you've given away your profits from 2021. You're still holding 2020 profits. You're still holding 2019 profits. And the cash flow planning that we did for our clients back in 2019, I was able to show you that you were on track and that you were able to retire. Well, you're only better off from that time because expenses have elapsed. So you don't have to worry about those years of expenses, and you are ahead from that point in time. So again, I want to get back to perspective. We're not going to like it, but these emotional times are the times that selling out will destroy somebody's retirement. Doing the wrong thing right now, I've seen it done in people's portfolios where 2018, at the end of the year, they sold out, and then 2020, they saw another thing and they sold out, and they don't get back in until it feels good again. And then they get in just in time to see the next decline. And then by the time it's gone, they've missed out on 50 to 60% of opportunity on their portfolio, or they've actually locked in losses. And then worse, they never want to touch the stock market again. And really, it wasn't the stock market's fault. It was the emotional reaction during those times. And when you think about the times that most of you have all been through, and then equate that to today, and I'm not going to even draw any assumptions that you just think about that and reflect on that and think about where we're at today compared to what you've already been through, especially in the stock market. And it's not even close.
Yep. So it really is an opportunity. It's an opportunity to put cash to work or put assets to work. I've been doing this for 41 years this year. And in my career, I've seen 10 of these where we've had something fairly significant happen, a major decline, but it's not anything like some of them that we've gone through. I remember in 1987, the market dropped 25% in one day. And I was in a trading floor in Minneapolis when it happened. It was chaos. So, we've experienced a lot worse. 2008 and 9 was much worse than this. At this point, obviously, we're early in this crisis, if you will, but just stay calm, stay the course is always the best advice and always the best way to respond. We don't want to react to these kind of situations, but to respond to them, we do want to respond, and staying calm, looking for opportunities, take advantage of those opportunities if you can.
Yeah, to that's really what I would talk about right now. This is going to be a time, just like if you were to look back, hindsight financial. If you were to look back at 2008 and you looked at a chart, you'd go, I wish I would have bought there. And it looks different on a chart because time's elapsed and you see the line and how big it is. This is going to be one of those times over the next 10 years that you looked and you went, man, I wish I would have put at least a little bit of money to work right then and there. It's going to be that. Corporate profits and consumer, especially in the United States, are telling us all we need to know. And there will be disruptions in that, but those are opportunities currently. So at that, we did do some rebalancing and we add some hedge positions, added a little bit more to value and bought into growth in most portfolios. There might have been some where we talked because tax reasons we didn't make some of those adjustments, but
Kyle, do you anticipate maybe looking at another rebalance at this point?
Yeah,
possibly.
Yeah, we're kind of doing some of that. We're looking over people's cash balances and things that have come due. We're also, I'll put this out there to people because I don't know how many people are aware or not, but we have a strategy, not a product, a strategy that involves zero coupon bonds and options, and you can really structure those in different ways to create different, it really defines your outcomes. So we have one that we actually just did over the past 2 years that it gave you a 10% downside protection. Yeah, so it's called a buffer. But that buffer either absorbs your first 10% of losses if over a certain period of time, like say you're down 13, you'd be down 3 at the close of that time that we defined. If you were in between that 0 and 10, and this was tied to the S&P 500 index and the NASDAQ index, if you were at like 5 or 6% down, you would actually get that positively, inverse. So 6% down would equal 6% positive to you. And right now we're looking at one, and the terms are uncapped on the upside over 2 years, and a 17% return that you could get over the 1 year. So we're kind of looking at ways to hedge people's portfolios too. You wouldn't, you would ask, oh, that sounds too good to be true. Why wouldn't I do that? And in non-quad, couple of things that come up for me is liquidity. I would never put somebody's whole portfolio in it. There's a certain amount of your money you need, and I wouldn't feel comfortable putting that on a 1 year timeline or a 2 year timeline. Second would be taxation. If you had a non-qualified account, or say some of your assets came from selling another asset, you would end up paying ordinary income instead of capital gain. But there's no change in how we're compensated on those. We're not looking for commissions. There's nothing changed. What it does is creates a hedge in the portfolio, which helps us enhance portfolio performance, especially in the downside. So that's why we're looking at it. What the banks get out of it is not a commission. They just get to go loan your money out 3 times over, 6 times over that year or the 3 years. So I always ask those questions to make sure we understand what we're doing. But those are options too. So if that's ever something that you're interested in, let's have that conversation. But we've already added some hedges into your portfolio in the last rebalance via a mutual fund. So it's called hedged equity, and it cuts about 50% of the downside of the S&P and allows us to participate in about 70% of the upside. And we added that in about 10 to 12% increments into people's portfolios, exactly for this, because we weren't sure we were at a bottom. We never are. We use kind of the averages, and simplistically, I look and go, okay, as long as the market, if we're down 12% year to date, and we at least get back to normal, that's a 12% return for somebody, even if it takes a year. And then with where the markets are being priced right now, we were expecting from January to December 31st for the markets to be up anywhere from 8 to 12%. So add that onto the decline that's already there, and you're looking at 20. Okay, well, even if that took 2 years, what's that average? 10% a year. I'm doing most people's forecasts conservatively and intentionally around 5%. And if we can create those types of opportunities out of these downturns, that's what we're looking to do. And that's the kind of active management that we're adding during times like this. And again, a lot of the factors we're looking at, I won't be able to say that 9 or 10 years from now. I won't be able to tell you corporate profits are rocking. We won't be able to tell you that consumers this healthy. So a lot of our strategy will change at some point, and that's actually what gives us some peace of mind on how we're managing this. The answer won't always be just invest, buy the dip. We'll change at some point.
Yeah.
If you guys do have any other questions,
yeah, please reach out. Send an email.
We're ready to respond, and that's what we're here for. We're here to help you manage this. And there's no question that we think is stupid. We get to do what we do because we're serving you, and we're really grateful for it.
Thank you.
Thank you for allowing us to work in our gift set.
Yeah.